Hi, good evening, ladies and gentlemen. Thank you for joining tonight's Corporate Connect. My name is Gerald, and I'm your host for today's Corporate Connect with LHN Limited. So this webinar is organized by SIAS and supported by the SGX Group. We also warmly welcome the audience who has joined us from Mumu Live. So we'll kickstart today's webinar with a market highlight segment from Mr. Jeff Howie, market strategist at SGX, before we dive into the corporate presentation by LHN Limited. So without further ado, I'll hand over to Jeff, who will share with us some of the key market updates.
Gerald, thank you very much. Just a kind reminder, this is an education event tonight, something that SIAS has been a relentless champion of, and Beansprout in recent years as well. Quick, very market update. What I will say first and foremost is the STI did form a fresh all-time high today at 39.28.81. I don't think I've ever been able to say that in my career here. So I just wanted to make that point first and foremost. What did it come on the back of? A pretty strong 10-month rally driven by financial services, obviously, and some of the ICT stocks as well. MTI announced last week that the Singapore economy expanded 4.4% last year. The year before was revised upwards from 1.1 to 1.8%. And overall growth last year was mainly driven by wholesale trade, finance, insurance, ICT, and those couple of manufacturing sectors. The outlook for this year is still in the vicinity of 2.5%. There are growing downside risks based on the very fluid outlook for trade tensions, with Washington obviously reassessing its economic relations across the world. Looking now at the real estate sector, which for the next 10 minutes, I would like to hone in on, that's the real estate excluding the REIT sector. The GDP report revealed that for last year, the real estate sector grew by 3.5% year on year in the fourth quarter, and that was driven by increased activities in private, residential, commercial, and the industrial segments of Singapore's property market. And that resulted in a 0.2% overall expansion for the year, which was down from the 3.8% growth that was printed in 2023. And while that growth might seem small, it's important to note the various sub-themes that are driving the industry forward. We're seeing a strong focus on sustainability, adaptive reuse of property, integrated developments, capital recycling, rising demand for co-living spaces, and of course, integration of tech in property management. Hong Kong Land Holdings has started the year as our most traded real estate stock by average daily turnover. In the past, City Developments has usually taken that crown, but it's Hong Kong Land that's the most traded real estate ex-REIT stock. Its new transformation strategy focuses on being an ultra-premium integrated commercial property manager, aims to position them as the leader in Asia's gateway cities by 2035, gateway cities being Shanghai, Hong Kong, and Singapore. And its financial goals include doubling its underlying profit before interest and tax, doubling dividends per share, and growing AUM to $100 billion and also actively recycling up to 10 billion in capital, sorry. And what we saw for this stock too, from the day before it announced this new transformation strategy right through to the end of last week, your 12-month Bloomberg consensus estimate target price on the stock was gradually raised from a $3.63 up to $4.94. And I think that the stock trading, as you can see here, around $4.35. Now, this table, I've just got a very simple two-step analysis. Firstly, it consists of the 10 most traded real estate excluding REIT relevant stocks this year. It then secondly sorts the stocks by the highest percentage growth in average daily turnover over the past 7 weeks compared to the full 2025 year. So Tuan Sing is up the top. Its average daily turnover rose from 70,000 Sing dollars in 2023 to 120,000 Sing dollars in 2024 and up to 440,000 Singapore dollars a day so far this year in 2025. And WeHer Holdings is just after it. You can see it's increased from around $20,000 a day in 2023 to 1.16 million in 2024, up again to 3.6 million in the past 7 weeks. So just for the next 5-8 minutes, I want to just look at those 5 stocks there at the top that have seen the highest percentage change in average daily turnover over the past 7 weeks compared to the full 2024. And interesting too, 2 of those 5 stocks have also been among our best performing IPOs over the past 10 years. Propnex has generated a 420% total return since it listed in June 2018. And LHN, which listed back in April 2015, has gained, I think, around 260% in total return since its listing. So first, Tuan Sing, the property segment focuses on developing properties for sale and investment in Singapore, Australia, Indonesia, and China. That property segment is pretty much well renowned for high-end residential projects in more prime locations, and they currently plan to engage in large-scale integrated developments in townships in their next phase of growth. And it includes a planning application for a very iconic mixed-use development at Melbourne's premier intersection in Australia. They should be reporting their FY24 results in the last week of Feb, so next week by the end of it. And back in August 2024, it noted its acquisition of Fraser Residence River Promenade had supported its strategy to expand hospitality and was expected to boost performance in the second half of last FY. It also noted that the divestment of greenfield land in Fuzhou, China, was anticipated to yield a gain of, I think, close between 18 and 19 million Sing dollars upon completion. So there'll be things to watch. For the next WeHer Holdings, it's evolved from a very construction-focused company into a dynamic, diversified group that spans construction, development, fund management, alternative investments. Back on the 16th of Dec, it announced it had secured an exit from its purpose-built student accommodation portfolio, but would retain a 13% stake. It would generate approximately 320 million Sing in net proceeds to support its further strategic growth and reinvestment. Management highlighted also that transaction, which spans something like 5,500 beds across key Australian cities, will mark a really important milestone for the company in its long-term strategy to further pursue sustainable growth, not just in the student accommodation, but across all the different multiple sectors. So it's seeking approval of shareholders for the transaction at an EGM on the 28th of Feb, and it's expected to report its FY24 results by the 1st of March, so by the next day. Its gross profit for the first half of the last FY24, I think it surged by around 140% to 45 million Sing, which was driven by revenue growth and stabilized costs in its construction segment. And LHN, which we're all here to learn more about tonight, so I won't take too long, but its real estate management services specializes in redesigning underutilized spaces, 4 main business segments, which you're going to hear about. I think its residential business had close to 2,900 keys across its co-living properties as of the 30th of September. And its last FY attributable net profit was also a record. So I don't want to steal the show, but also really important point, this company also transferred from the Catalyst board to the main board back on the 13th of December last year. Propnex, just 2 more to go. It maintains the largest real estate sales force in Singapore. Its key business segments include brokerage, training, consultancy. They will report their FY24 results by the end of last week as well, end of next week as well. In November, they maintained property demand this year would be supported by our economic recovery, slightly lower interest rates, growing population, stable job market. It estimated there would be close to 14,700 units in total in Singapore across 34 projects launched in Singapore this year. And moreover, I think in the Edge magazine back in January, Vijay, who's at RHB Bank in Singapore, he also upgraded Singapore's real estate sector to overweight from neutral. He also saw the residential market was looking set to make a comeback this year, following that sharp pickup in buying interest that we saw in the new launches in the fourth quarter of 2024. And remember, in that first slide, also I mentioned how real estate had grown strongly in the fourth quarter and therefore brought the whole year into a slight gain, a slight marginal growth. Centurion Corporation owns, develops, manages the specialized accommodation assets across 6 countries now, but mostly in Singapore. Prior to 2024, it had actually streamlined its listings by ceasing its Hong Kong listing and just keeping the Singapore listing going. Its shares gained strongly last year as well. It saw a 25% increase in revenue for the first 9 months of the year to 187 million Sing. Purpose-built workers accommodation segment was around 3/4 of the revenue, while purpose-built student accommodation was around 1/4 of the revenue. In terms of the geographical distribution, Singapore's around 2/3, and they continue to anticipate continued positive demand-supply dynamics, and will also report by the end of last week. So, just wanted to give it that quick roundup because, as I said, these were. I've really just looked at 6 stocks. We looked at the most traded stock in the real estate sector, excluding the REITs, which was Hong Kong Land, and then also look at 5 stocks as well that rank among the 10 most traded, but the 5 that have seen the most trading turnover growth or most trading participation growth so far this year. And I think it does show how we view the real estate sector in Singapore as well. It is seeing dynamic changes, all these new sub-themes as well, which I think is really interesting, and obviously looking forward to hearing more on the space optimization industry with LHN now. Thank you very much.
Thank you, Jeff, for the update. I think you have set the floor for us to really dive deep into LHN's operations, understand from the management team how they view the outlook. So without further ado, I'd like to invite the management of LHN. We are very pleased to have with us today Ms. Jess Lim, Executive Director and Group Deputy Managing Director of LHN, as well as Ms. Yeo Swee Cheng, the CFO of LHN Limited. So we'll invite the management to share their presentation first before we go into the Q&A segment. Over to you.
Thank you, Mr. Wong, for your introduction. Good evening, everyone, and thank you for taking time out to attend our company's sharing tonight. So today, I will be covering briefly on our group's business, our 2024 financial performance, as well as our growth strategies and business outlook. LHN is a real estate management services company. We are listed on the main board of Singapore Stock Exchange, as well on the Hong Kong Stock Exchange. Our market cap as of 17th of February was approximately about $225 million. Our company has a free float of approximately 45%, with the remaining 55% held by our controlling shareholders. LHN has 4 business segments. Our core business segment is in the area of space optimization, and that is where we manage commercial, industrial, and residential spaces. So under our commercial property portfolio, we manage various types of commercial space, such as offices, sports and recreation centers, and lifestyle spaces. We also have a service office brand operating in Singapore, where we operate 1 service office in Singapore and also 1 service office in Jakarta, and that's under our Green Hub Service Office brand. Under our industrial property portfolio, we manage mainly B1 light industrial spaces, including 7 self-storage facilities under our Work Plus Store brand in Singapore. And under our residential property portfolio, we manage various types of accommodation, including co-living service apartments, hotels, and student hostels, serving mainly expats, foreign students, and also young adults. And that is under our Koliwu brand. And in overseas, we have where we operate in Cambodia and Myanmar, we have service residents operating under 85 Soho brand. Next, we have a small property development arm, and this is where we have a development project at 55 Tuas, where we have developed a food factory with 49 factory units. Currently, the building has received its TOP, and we are in the midst of marketing the units for sale. Our third business segment is in the area of facilities management. So under this business segment, we operate a full service facilities management company, providing a full spectrum of integrated FM services, such as cleaning, pest control, landscaping, aircon maintenance services, and other building maintenance services. So over the years, our FM business had been successfully overcoming high labor costs by deploying technologies to complement the growth of this business at a steady rate. So today, majority of our customers are external parties, including industrial building owners, such as the REITs, manufacturing facilities, and commercial property owners. We also run a car park management company, providing management services to car park property owners, MCSTs, as well as government agencies. Today in Singapore, we operate 99 car parks, and in Hong Kong, 3 car parks. Lastly, our group's energy business focuses on the retail of electricity and provision of efficient and innovative renewable energy solutions to our customers. Our team specializes in solar panel installation services, and we also operate electric vehicle charging stations at some of our managed car parks. In FY 2024, we have doubled our solar energy generation capacity to almost 9 megawatt peak from the previous year. And in this new financial year, we are expecting to grow this segment at an even faster rate. So next, I would like to share a little bit more about what we do in our space optimization business. So today, our space optimization business portfolio comprises of 15 owned properties, 6 JV properties, as well as 25 master lease properties. So our space optimization business actually contributed to almost 68% of our group's revenue in FY 2024. And within this business segment, our commercial portfolio contributed 5.2% of the space optimization revenue, followed by our industrial portfolio at 30.4% of the space optimization revenue, and lastly, our residential portfolio at 64.4% of our space optimization revenue. In this slide, we'd like to present to you our Koliwu portfolio of properties. Today, Koliwu's portfolio of properties comprises of mainly service apartments, hotels, as well as white-collar and student hostels. 16 of them are self-operated. Our 2 biggest co-living properties are located at 31 Boon Lay Drive, which has 437 rooms, and at 2 Mile E Link, which has 211 rooms. We have 4 properties currently undergoing renovation works, which are mainly 141 Middle Road, 50 Armenia Street, 48 and 50 Arab Street, as well as 260 Upper Bukit Timah. We have 6 other co-living properties which are subleased to operators, which is what you see on the top section of this slide. We also manage 2 co-living properties at Boundary Close and Ulu Pandan for healthcare professionals. And lastly, we recently also took over the management of a 20-room hotel accommodation converted from retired buses called the Bus Collective Hotel, which is located in Changi next to the Changi Village. So this Bus Collective Hotel is a unique and innovative hotel concept which offers one-of-a-kind stay experience with an eco-friendly and sustainability theme in mind. Next, I will hand over the mic to our CFO, Ms. Yeo, to share with us our FY 2024 financial performance.
Hello, everybody. Good evening. Okay, next is our FY 2024 financial results. Our net asset value per share as at 30th September is 60.77 cents, with a profit after tax of 47.9 million. We achieved a profit attributable to shareholders of 47.3 million, and group revenue stand at 121 million. Our space optimization profit before tax is 46.2 million, facilities is 4.7 million, and our energy business is 0.7 million. Next. These are some of the income highlights. Our revenue increased by about 27.4 million, or about 29.2%. And this increase is mainly come from the co-living business, as well as our car park business, and also the cleaning and integrated facilities management business. Our profit attributable to shareholders from the continuing business increased by about 155.1%, or 28.8 million. And this is mainly due to the profit from the co-living business, some fair value gain on disposal of our JV car park, and also partially offset by absence of one-off gain on the disposal of our associate company in 2023. The profit from the discontinued operations is actually 19.7 million in FY 2023. For this year, we don't have any more because we've already disposed this logistic business. Next. Next page, Jess. Okay, revenue breakdown. Sorry, the other page, revenue breakdown. Okay, revenue breakdown by segment. The industrial segment increased marginally. And for the commercial segment, there's a drop of about 1.6 million, mainly due to the derecognition of revenue for certain properties in the second quarter of 2024. And then for the residential properties, there's an increase of about 24.2 million. This is mainly from the co-living business because we recognize the full period contribution from our 2 more properties and also the Lavender properties. And then for the co-living business, we also have some services provided under the co-living management business. And we also have higher profit, higher revenue from the existing properties due to higher rental rate. Facility segment increased by about 4.2 million. And this is mainly from the increase in the car park business and also our cleaning and integrated services business. Energy business increased by about 1 million, mainly due from the solar energy business. And overall, there's an increase of about 27.4 million revenue for FY 2024 compared to FY 2023. Next. Adjusted segmented profit before taxation for the different segments. Industrial property actually decreased by about 3.5 million, and that's because gain from sublease was recognized in FY 2023. For the commercial properties, there's a marginal decrease of about 393,000. And then for the residential properties, there's an increase of about 4.7 million. And this increase in the profit is actually mainly from the contribution from the co-living business. The facilities management business has a drop of about 2.7 million or 2.65 million. This is because of the we have actually lower car park profit from the Hong Kong segment, Hong Kong car parks. And so this car park performance was actually not as what we have expected. For the energy business, there's an increase of about 300,000. For the corporate business, there's a drop of 8.5 million. That's because in FY 2023, we actually have recognized the disposal on a gain of the logistic business under the corporate segment. Fair value gain in FY 2024 is a profit of 14.7 million versus a loss of 8.7 million in FY 2023. And the reason is because we have completed some renovation for certain of our properties, and as a result, there's an increase in the valuation of these properties. And also, we have higher valuation for certain properties, which has higher occupancy and higher income. Other one-off items, in 2024, we disposed a car park property at 2.4 million profit, as compared to FY 2023, where we have actually got a gain of when we dispose our associated company GetGo. For the discontinued business, 3.1 million in FY 2023 is referring to the logistics business. So FY 2024, there's nothing. So overall, group segmental profit increased by about 7 million. The total keys secured for FY 2024 is 2,541. There's an increase of about 860 keys. For the total locations, we have 25 locations as at 30th September 2024, compared with 2023, which is 17. So there's an increase of about 8 locations. Customers increased from 83 to 113. So there's an increase of about 30 customers. For the number of car parks that we manage, increased by 22 car parks, from 80 car parks to 102 car parks as at 30th September 2024. Gearing. So the gearing for FY 2024 has increased from 56.2% in FY 23 to 59.6% in FY 24. This is due to acquisition of new properties such as GSM property, 288 River Valley, and also the Rangoon properties. Similarly, net gearing also increased by about 8 percentage points. The return on equity is about 18.6% as compared to FY 23 of 18.4%. Operating cash flow decreased mainly due to the increase in the construction cost for our property at 55 Tuas, and also we paid down some of our renovation loans. Net asset value per share as at 30th September 2024 is 60.77 cents. The dividend per share for this year remained at 3 cents. For 2023 is also 3 cents. So the dividend yield is 7.1% as the price of the LHN Limited shares has gone up. For all the properties, you can see across all the segments that we have very high occupancy of more than 95%.
Thanks, Trishan. So next, I will be sharing with all of you a little bit on our business outlook and some of our growth strategies. So in FY 2024, as presented by our CFO, we had achieved a healthy revenue growth in our space optimization, facilities management, and energy business segment. So although a lot of focus has been targeting to grow our residential co-living business, which has yielded us a very good performance, as at the end of FY 2024, we have secured a total of 2,895 keys for our residential portfolio in both Singapore and overseas, of which 2,541 keys are located in Singapore. So our growth strategy for our co-living business remains to target to grow at least 800 keys every year. And we target to achieve this growth via master leases or selective acquisition. And to balance up our capital requirement for our business growth, we are also actively carrying out capital recycling efforts, moving towards a asset-light model. So this is our FY 2024 projects, which is already in operation, which is namely a hotel project in 404 Pasir Panjang Road, student hostel in 99 Rangoon Road, and also a service apartment at 260 River Valley. What you see in this slide is also one recent newly launched property at 288 River Valley Road. So this is also a service apartment property. Projects in pipeline. So in the pipeline to be launched in this financial year 2025 will be 3 residential co-living projects at 48 and 50 Arab Street, 260 Upper Bukit Timah Road, which is the previous fire station, and our GSM property at 141 Middle Road, which will contribute to our income in FY 2025. As for the last property at 50 Amelia Street, it will be expected to be ready by FY 2027. Okay. Our newly launched 55 Tuas Food Factory is now in the market for sale. So this project has a total sellable area of 112,000 square feet with 49 units to be sold. Revenue from the sale of this property is expected to contribute to our FY 2025 financials. After this project, okay, we have also identified a new project in Geylang as announced last Friday, and that would be recorded as a revenue under our development business arm. So to meet the capital requirement to help in our business growth for our group, we are actively carrying out capital recycling efforts and moving towards a more asset-light model. So as you can see in the last financial year, to support this strategy, we had actually sold our car park located at Bukit Timah Shopping Centre for a sale price of 22 million and had utilized the sales proceeds to acquire new property at Wilma Place. In summary, as shared, we will expect the growth momentum for our various business segments to continue in the new financial year 2025, and mainly it will be in Singapore. So for our co-living business, we are also evaluating selective overseas expansion opportunities in the ASEAN region, possibly in Indonesia, Malaysia, or Thailand. So this is the end of our presentation, and we thank you for your attention. We'll be happy to receive any questions from the audience.
Thank you, Ms. Lim, and thank you, Ms. Yeo, for your sharing. For the participants who have joined us today, if you'd like to ask a question, do put them into the Q&A section of the Zoom meeting that you have joined. But I would like to start with a number of pre-submitted questions from the audience. I think you have shared a lot about your strategy. One of the segments that the audience is keen to know more about is about the co-living space. Maybe you can share a bit more about the trends that you see here. How do you see the segment actually evolving over the next few years?
Okay, so our company is actually very upbeat about the co-living segment, especially in Singapore. So we feel that and we believe that co-living is the way to live coming forward. And in co-living business, we are also talking about a lot of community building, okay, for our residents. And that is the core of our service offering in our co-living business. So in Singapore, as you know, is aware of by everyone, the cost of buying an apartment is getting higher and higher every year due to inflation. So we feel that there is a market for co-living space.
Apart from this trend that you see around higher property prices, what else is making you bullish about the segment? Do you see a lot of supply coming into the market? Is it becoming more competitive?
Okay, the segment of residents where stay in our co-living spaces are mainly coming from foreign expats, international students, and also young professionals, as shared previously. So as Singapore becomes a hub, for international meetings, conventions, and financial activities, we believe that the demand for our co-living spaces will remain strong coming forward.
Okay, thanks so much for sharing the outlook. The next two questions relate to your strategy. The first is really around expansion outside of Singapore. Do you see any opportunities in other parts of Southeast Asia, such as in Malaysia, especially now with the Johor Special Economic Zone being something that's talked about often, or other markets such as in Indonesia?
Okay, we are quite optimistic about expansion in ASEAN and growth opportunity, especially in the ASEAN region. So actually at this moment, we are currently looking into opportunities to expand our co-living business into Malaysia in the area of possibly senior living. And we are also quite excited to see how the Johor SEZ pans out. And that may be also opportunities for us to expand our facilities management business in the area of energy solar installation.
If you were to expand overseas, what would be the strategy that you would take to expand into these markets? Do you have the right people to be able to help you expand into these markets?
Okay, currently, our group has existing businesses in Indonesia, where we have been in the market for the last 10 years, operating service office businesses. So in terms of the industry, we do have a lot of ground knowledge, and that is also one country where potentially we can also consider expansion of for our co-living business. So I think market knowledge in the country where we identified expansion is very important, and as well as a team, having a ground team, in the market will also be a very important aspect for us. Of course, when expanding into a new market, usually we will consider taking on master leases first, instead of making direct acquisition.
Okay, since we are on the topic of co-living, take a live question from Andy. Is the slowdown in incoming China tourists affecting your co-living model?
Incoming
Slowdown in incoming China tourists.
Oh, okay. So actually, within our co-living portfolio, right, we operate a mixture of service apartments, hotels, okay, and other residences. So a lot of our residents actually are foreigners who work in Singapore, international students. So as for China tourists, reduction in the number of China tourists coming into Singapore, we feel that it might not have a negative impact to our business, because they do not make up the majority of our customers.
Do you have an estimate how much of your customers today actually make up?
Less than 5%.
Okay, so that hopefully helps to address Andy's question. Maybe relating to that, I think quite a number of questions relating to the risk that you see for the company. The next question is by Grace. What do you see as some of the challenges and risks that the company may face? And I guess related to that, how are you addressing some of this risk?
Okay, the most immediate area that we are actually quite concerned is actually the interest rate, the interest rate outlook. Okay, because as you know, a lot of our properties, okay, some of our properties within our co-living and even our space optimization business are acquired. Okay, and any increase in the interest rate environment will cause our interest costs to increase and operating costs to increase. Yeah, so interest rate will be one of the major concern that we have, which we need to manage closely. In terms of other challenges and risk, I feel that Singapore is a very quite open economy. Okay, so geopolitical risk would also need to be closely monitored. Okay, and our company will need to be very nimble to be able to react to this geopolitical risk.
relating to the question on interest rates, are you able to hedge your interest rate exposure by, say, taking on fixed debt?
Okay, actually, we manage our interest costs by having a good mix okay, of fixed interest rates plans, financing plans, and also floating interest rate financing plans. So this will help us, have manage our interest costs in a reasonable manner. So let's say if the interest rates are reducing, then we'll be able to enjoy the lower interest costs.
If I were to look at interest rates today, given where interest rates are in 2025, would you say your average borrowing cost today will be higher or lower than what you had to incur in 2024?
We are expecting our interest cost of borrowing to be lower as compared to FY 2024.
And are you able to share any sensitivity if, say, interest rates go down by another 100 basis points? How much will that help in terms of your financing cost?
Swee Ching, you want to take this question?
Yeah, okay. So actually our portfolio comprises both fixed and floating as what Jess has mentioned. So of course, at the time of acquisition of properties, we would have done our analysis and our basing on our current interest rate or whether it's being charged by the bankers. So any drop, as we see now, the actually interest rate for SORA is dropping actually. Previously was about 3.5, at one stage was even 3.8. So now it's about between maybe 2.6, 2.8. So actually there's already a significant drop in the interest rate. So we have already done the necessary precaution on all the interest rate adjustment. Yeah.
Okay, thank you. Back to the question on expansion to overseas markets, there's a follow-up question by Andy. Given the opportunities in Johor, SEZ, wouldn't it be appropriate for LHN to be expanding into Malaysia and tapping on the opportunities there?
Actually, we are quite open to consider opportunities to expand into Malaysia, definitely. Yeah, so it depends on how the Johor SEZ plans pans out. But as I mentioned just now, if we do go in to Malaysia, probably one of the first few projects will be taking on a master leases instead of direct acquisition.
Okay, I hope that answers your question, Andy. If you've got any follow-up questions, feel free to ask in the Q&A box. There's a question from Benjamin. There was also a related question on this that was pre-submitted. Some of your recent profits have been significantly impacted by your property revaluations. Is this something that investors should continue to expect? And is there anything that's being done to be able to boost your operating profits or recurring profits?
Swee Ching, can you?
Yeah. Jess, do you want to refer to page 14 of the slides?
Page 14.
Yeah.
Let me... Is this the one? Yeah.
So if you look at our core profits here, okay, of course, our company main business is in the business of other than rental, is that we are supposed to so-called increase the value of each of the property when we acquire. So every time when we acquire property, we will do renovation. After the renovation is done, the property valuation automatically will increase. Okay, so increase in property valuation not only because of the completion of our construction of property, but also because we're able to achieve high occupancy and higher revenue in terms of higher price or higher rental. So if you look at the performance of our group, okay, although there's a lot of valuation gain, okay, if you look at fair value gain, 14.7 million versus 8.6 million loss in FY23, but if you look at the above the line, okay, actually our core profits is still very strong. If you add up everything, is actually FY24 is 34.2 million. For FY23 is 44.3 million. But in this 44.3 million, actually under the corporate, there's a gain on disposal of our logistic business of 18 million. So what I'm trying to show is that in actual fact, our core operating profit, even without a one-off and without a fair value, there's still an increase of about maybe 10 million.
Maybe as a follow-up question, I think we have seen the performance in the past. Going forward, what can the company actually do to be able to grow your recurring revenue so that it is something that investors will be able to forecast or predict with more certainty?
So as mentioned earlier by Jess, we will continue to acquire lease properties also, because lease property actually the IRR is much higher. And although there's some capex, but the capex compared to the acquisition of the properties is much lower. And we will expect that we have many leases which are long-term leases, like for example, Tumau, Lavender, all these are long leases. These will have actually recurring income for us other than the assets that we own.
Do you think
So we actually have also we have actually projected that we want to increase the number of keys of 800 per year. So all these will add on to the recurring profit that we have.
if you're to take on some of these activities, will you have to take on more debt? Do you think you have the balance sheet capability to be able to take on some of these activities that you shared?
Okay, so debt is inevitable, okay, depending on what kind of debt. If you acquire a property, the debt is higher. But if you acquire a lease, so it's only the renovation cost. So we have mentioned that we are actually towards the asset-light model. So we will be acquiring more leases. That means less on the purchase of the property cost. It's more on the renovation, and we have acquired normally we acquire long leases, and that will bring us certainty in the number of years of recurring income.
Okay. Andy has some questions on your property development business. First and foremost, relating to Food Factory, is that considered a one-off transaction?
Okay, definitely. For our property development business, we will selectively take on new or other property development projects after the conclusion of the sale of this Food Factory. So it will not be a one-off project for our property development business.
Okay, and relating to that, I guess you have got a number of your shareholders who are on this webinar tonight. They're all looking forward to being rewarded upon the sale of the Food Factory. So what would you have to be able to distribute as part of this transaction?
Okay, so of course, definitely, wherever there is opportunity, we will always look towards rewarding our shareholders who has been, supporting our company, definitely. Yeah. But of course, from the management, we also want to balance this up so that, we also would like to reserve some of these gains or profits to grow our business, to make it more sustainable.
Do you currently have a dividend policy?
Yes, we currently have a dividend policy. Actually, in the last 2 financial years, actually we committed to our shareholders that we'll distribute not less than 30%, not less than 30% of our profits.
Okay, thank you. Follow-up question from Ben. This then relates to the industrial and commercial segment. What are your plans to be able to grow these segments together with the residential segment?
Okay, so of course, although a lot of efforts has been channeled to grow our residential business portfolio, but we do see that there is also opportunity for growth, especially in our industrial properties portfolio. So under our industrial property portfolio, we have a self-storage business under the Work Plus Store brand. So in the last 6 months, we have been busy converting some of our Work Plus Store space to do more high value added or to provide more high value added spaces, storage spaces for our customers, which will be in the area of for wine storage, aircon storage. So this will be able to allow us to yield higher rental per square feet. So our self-storage business revenue is expected to improve in the coming financial year.
Do you have any targets for how big the industrial commercial segments could be compared to your residential segment?
So year on year, we hope that we will be able to grow our industrial property segment by at least 5 to 10%.
Okay, thank you. I don't see any further live questions. Maybe I can end off by asking a question in that, having shared your company and answer some of the questions, maybe you can summarize for us what might be some of the key reasons that you think that an investor should be considering investing in LHN.
Okay, so for us, we are a company in real estate management services. So we provide real estate management services in Singapore and also in some ASEAN countries. And in the area where we focuses our growth in, especially in the residential co-living space, we feel that there is good growth opportunities in Singapore and also in ASEAN region, because we see that residential space is a very essential space. Everybody need a space to live, and our kind of a co-living offerings is actually very comprehensive. We can live, work, and even play, network, within the co-living space we operate. So we feel that there is good growth opportunity in this area as well. And supporting our space optimization business are also our facilities management business segment. Okay, as long as you have real estate in any country, you will definitely need facilities management services, someone to clean your space, maintain your buildings. And lastly, just to share a little bit about our energy business, we are in a very exciting business segment where it is in support of the sustainability initiative. That is, the key message that every country is driving. So we see that there is a good growth opportunity for our energy business, although today at this moment is still not contributing a very significant amount to our overall group revenue. But you may want to note that year on year, we actually were able to double our energy capacity. So we hope that our shareholders can continue to support us and invest in our stock. And of course, when our company is able to generate good profit, we always did not forget about our shareholders. In the last few years, we have been giving out reasonably good dividends to our shareholders, and therefore we also hope that they can continue to support our stock.
Okay, just as you were sharing, I think more of our participants tonight wanted to find out more about your company. So a few follow-up questions that came up. The first is by Yihui around expected sales value and profit from the food factory transaction.
Maybe I will move on to the slides regarding the food factory. Okay. So as I shared with you, the total saleable area of our food factory is approximately 112,000 square feet. So 49 units. Okay, so these units are all available for sale right now. And to date, we have received some OTP from interested buyers already. Probably we're expecting to sell all the units before the end of this financial year. So therefore, we will expect this project to contribute to our FY25 revenue and profit.
Okay, and then this question from Grace. How many staff do you currently employ? What's your mix between local as well as foreigners?
Okay, so currently as a group, we employ close to 600 staff worldwide. Majority of them is located in Singapore. So, of course, majority of our Singapore headcount are also local.
Okay, thank you so much for the sharing. I think we have answered all the questions. First and foremost, would like to thank the management of LHN for joining us tonight. I think we have all been able to learn more about your company, as well as your outlook around how the company might grow over the next few years. For all the participants who have joined us tonight, I hope you found the Corporate Connect helpful as well as informative. If you found today's session helpful, but if you missed any part of it, you can actually rewatch the webinar on SIAS YouTube channel. So in case you are not aware, Corporate Connect is SIAS regular webinar where you'll be able to get updates from different corporates that are listed on the Singapore Exchange. The next Corporate Connect will be with ESR REIT. So if there's something that you're interested in, do sign up for the session and you can actually involve yourself in the discussion with ESR REIT. So with that, I'd like to thank everyone for joining us tonight, and I hope you have a very pleasant evening. Thank you so much.
Okay, thank you, everyone.
Thank you.